Welcome everyone to this strategic explainer. Man, if you've been tracking the European polymer markets lately, you know we've just been through an absolute whirlwind these past couple of months. I mean, think about the sheer whiplash your procurement teams must be feeling right now. We went from scrambling for absolutely every available metric ton back in the spring to suddenly staring down a massive, steep cliff in pricing. Today, we're going to break down this sharp July market correction. We'll look at exactly why that aggressive panic just kind of evaporated, what the underlying data is screaming at us right now, and how you should be positioning your strategies for the rest of the year. Let's get right into it.
And just a quick note before we dive in, everything we're covering today is sourced directly from the latest regional trade data and the official July 2026 Polymer Bazaar report for Western Europe and the UK. This is top-tier market intelligence, folks, the exact kind of data that literally moves markets. We've distilled the whole thing down into clear, actionable insights so you can walk into your next procurement meeting fully equipped and ready to go.
So here is our game plan for today. We're going to cover the summer market correction, look at feedstock and monomer movements, dive into the commodity polymers outlook, touch on the engineering plastics update, and wrap it all up with strategic market guidance.
All right, starting off with part one, the summer market correction, moving from panic to fundamentals.
We are witnessing a massive shift right now. We're moving away from those wild, panic-driven spikes and coming in for a hard landing right back onto structural reality. Remember back in April, escalating tensions and logistics disruptions, especially around the Strait of Hormuz, just triggered absolute chaos. Buyers were terrified of supply cutoffs and massive shipping delays, which led to some seriously aggressive inventory restocking. And that fear, it sent prices absolutely skyrocketing through May. But, here's the thing about panic buying. Eventually, the warehouses fill up. As those geopolitical tensions eased a bit into early summer, the reality of abundant global supply and pretty lackluster downstream demand set right back in. By June, market fundamentals had returned, paving the way for the incredibly sharp, swift, downward price adjustments we're dealing with now in July. It's basically a classic boom and bust cycle, but compressed into just 4 short months. And you know what really compounds this shift? The seasonal timing. We are right in the thick of planned summer maintenance and holiday closures across Western European converters. So not only has that frantic restocking stopped dead in its tracks, but normal, everyday spot demand is significantly muted too. Factories are quite literally turning the lights off for a few weeks. It's a double whammy for the spot market. You've got producers sitting on material and a buyer base that is temporarily just checked out. That complete lack of buying interest is piling heavy downward pressure on prices, leaving traders scrambling to find homes for their allocations.
Moving on to part two, feedstock and monomer movements, looking at the core data.
Let's actually look at how this builds into the granular data, because the core raw material costs are just plummeting, and that is the real engine driving our current reality. Ethylene didn't just drop, it plunged over 172 pounds per metric ton. Propylene is down more than 164 pounds. Styrene monomer, that took a massive dive, dropping a staggering 233 pounds per metric ton. Even Brent crude's monthly average is down almost 95 pounds. Honestly, this is a narrative of profound relief for procurement teams who have been severely squeezed on margins for months now. The whole foundation of polymer pricing has essentially hit the reset button back to pre-conflict levels, wiping out an entire quarter's worth of inflated costs in just a matter of weeks. Crazy, right?
Okay, part 3, the commodity polymers outlook, specifically focusing on standard polyolefins.
So what does this all mean for the actual market when it comes to standard polyolefins like PE and PP? Well, the impact is staggering. 400 pounds, up to 400 pounds per metric ton. That is how far July prices for most polyethylene and polypropylene grades have plummeted compared to early June. Let me tell you, it is incredibly rare to see a single-month drop of this magnitude. For procurement managers, this isn't just a slight, nice-to-have discount. It's an entirely different pricing paradigm. It literally demands an immediate reevaluation of your active contracts and spot purchases.
Let's break that down grade by grade, because the pressure is coming from absolutely all sides right now. Take LDPE. Demand is so incredibly muted that European producer margins have actually dipped into negative territory. That is a glaring, flashing red warning sign for producers who might soon be forced to slash operating rates. Meanwhile, LLDPE and HDPE are facing what you might call an arbitrage attack. We're seeing a heavy influx of competitive supply flooding in from U.S. imports. That's forcing local traders to aggressively lower their offers just to clear out spot material before it loses even more value. Over in polypropylene, we're tracking massive reductions of 300 to 400 pounds, although PP copolymer is holding up slightly better as domestic producers fight tooth and nail to keep their margins positive. And polystyrene? It dropped roughly 350 pounds, acting basically as a direct mirror to that massive plunge in styrene monomer we just talked about.
Which brings us to Part 4, Engineering Plastics Update, where we're seeing a very mixed tone.
Now, unlike standard commodities, the engineering and performance plastics sector is showing a very different, much more mixed market dynamic. While standard polymers are dealing with heavy price crashes and those negative margins we discussed, engineering polymers are actually seeing a bit more stability. They're benefiting from composite cost relief because raw materials like benzene and butadiene have dropped. But at the exact same time, they're facing intense, relentless pressure from competitive deep-sea imports. It's basically a massive tug-of-war between lower domestic production costs on one side and a flood of cheap foreign material on the other.
It's genuinely fascinating to see how this import pressure plays out across specific resins. For POM and PMMA, a heavy influx of competitively priced material from East Asia and the Far East is effectively putting a hard cap on any kind of domestic price recovery for European producers. We're seeing a really similar story for PA6 and PA66, which are just burdened by weak domestic demand and relentless non-EU imports. ABS prices are down too, leaving a lot of buyers in a cautious wait-and-see mode. But, here's the catch with waiting too long. If you hold off on ABS hoping for just one more price drop, you really risk localized stockouts when the auto manufacturing season kicks back into high gear. Meanwhile, polycarbonate spot prices dropped following direct relief in benzene costs, while PBT remains completely range-bound since weak spot buying is just totally offsetting any producer attempts at price hikes.
All right, let's wrap up with Part 5, Strategic Market Guidance for the Q3 and Q4 Outlook.
So what do we actually do with all this information? This is where we pivot from just reporting the news to delivering Polymer Bazaar's official, actionable executive guidance for the remainder of the year. If there is one overarching mantra you take away from this entire explainer, it's this: caution over panic. We are navigating a post-volatility floor. The market has firmly, definitively transitioned from the aggressive panic restocking days of Q2 right back to a highly conservative hand-to-mouth procurement strategy. The goal right now isn't to build massive safety stocks. It's to strategically manage your cash flow while buying just enough to keep the lines running.
To navigate this successfully, there are 3 strategic realities you absolutely must monitor. Step 1. Recognize that the bottoming process is fully in motion. With producers seeing negative margins and monomer contracts settling so much lower, we are fast approaching an operational floor. Further dramatic downsides are mathematically pretty limited at this point, simply because producers won't run their plants at a loss forever. Step 2. Keep a close eye on the geopolitical risk premium. Watch those Middle East shipping lanes. Even setting the politics aside, these are vital global choke points. Crude oil has already shown brief intra-month spikes, so that supply chain risk, it hasn't entirely disappeared. And Step 3. Navigate those import arbitrage pressures. Competitive deep-sea cargoes from the US and Asia are absolutely going to continue capping European price recoveries. Weaker domestic demand over in Asia is pushing excess volume toward Europe, so expect that ceiling on prices to hold firm.
Based on all those realities, here's our specific guidance for you. Secure selective baseline coverage for your September replenishment and do it now while taking advantage of these current price bottoms. As seasonal plant maintenance lowers capacity utilization through the rest of August, you should actively be locking in those essential volumes. Why? Well, because demand is inevitably going to pick back up post-summer holidays. Yes, for sure, high global supply will keep any massive market surges in check through Q3 and Q4, but locking in at these current floors is just the smart strategic move. If you wait until September, when literally every other converter turns their machines back on, you risk losing out on these bottom-of-the-barrel spot opportunities.
Which leaves us with the ultimate question to ponder. Are you positioned for September replenishment? Are you proactively taking advantage of this temporary summer floor before the rest of the buyers flood back into the market? Right now is the time to evaluate your procurement strategy and lock in that competitive edge. And hey, if you need instant market data to make those high-stakes decisions, you can just WhatsApp the word Europe to the number provided to get 5-second replies from Polymer Bazaar's AI-powered chatbot. It's a seriously fantastic, immediate tool to keep you ahead of the curve. Thank you so much for joining me for this market explainer, and stay strategic out there.